Welcome back to the deep dive. We've got the usual stack here, financial statements, presentations, transcripts, this time for Polycab India Ltd.
That's right. We're digging into their first half results for fiscal 26, so that includes Q2 ending September 30th, 2025.
And our mission today really is to figure out what's behind these, frankly, record results they've posted.
Exactly. We want to unpack the drivers, see how their big strategy, Project Spring, is actually progressing, and look at the risks and opportunities ahead, especially with India's infrastructure push.
Yeah, you can't ignore the headline here. Highest ever consolidated revenue, EBITDA, and PAT for any half year in their history. That's quite a statement.
It really is. It suggests, strong market wins meeting a company that's gotten its operations really humming.
Okay, so let's dive into those H1 numbers. Consolidated revenue up 21% year on year.
Yep, a solid 21%, breaching that 120 billion mark.
But the profit growth was even more striking.
Oh, absolutely. That's where the leverage shows. Profit after tax jumped 53% year on year for the half.
53%. And
Well,
Q2 specifically.
Q2 PAT was around 7 billion rupees. That's a 56% jump compared to Q2 last year.
Okay, wait. Revenue up 21%, profit up 56%. That kind of gap often points to, I don't know, a one-off gain or something unusual.
It's a fair question, but here it seems mostly driven by really good operating leverage, spreading fixed costs over higher sales volumes, plus some procurement discipline.
Ah, okay.
That's what boosted the consolidated EBITDA margin up to 15.2% for the half year. It's genuine operational improvement flowing through.
Right, that makes the performance feel more structural, more sustainable. Good.
Good.
But we can't just talk financials. There were some big non-operational things hanging over them, weren't there?
Agreed. Two really key governance points got cleared up this period. First, the CFO transition.
Right, Mr. Tangia is leaving.
Yes, and they've brought in Mr. Nayat Maru as Executive President Finance. He's designated as CFO starting late October.
But I noticed it's for a fixed term, only 9 months. Doesn't that sound a bit temporary, like a placeholder?
It could seem that way, but it's likely more about ensuring continuity while they conduct a thorough search for the permanent successor. It avoids a leadership vacuum, which is crucial right now.
Makes sense. Stability matters.
Yeah.
Okay, but the really big news, the one impacting valuation for sure, was the tax issue resolution. The one from that search back in December 23.
Yes, this is huge. A massive cleanup. Remember that tax demand? About 525 million rupees, plus another 175 million in interest.
Yeah, that was a big cloud hanging over the stock.
Well, that aggregate demand is now NIL.
Nil, as in zero, gone.
Precisely, wiped clean. The CITA order came through during Q2. This isn't just an accounting adjustment. It removes a major regulatory overhang. Big relief for them and for investors.
Okay, so with that tax uncertainty gone, they can really focus on the core business. And that's still overwhelmingly wires and cables, right? Like 84% of sales.
Absolutely. It's the engine room. And that segment grew 21% year on year in H1, driven mostly by really strong volume growth, high double digits.
Now, here's where I thought it got really interesting. They hit that 21% domestic growth despite comparing against a massive Q2 last year. Didn't Q2 FY25 grow like 28%?
Exactly. That's the crucial context. Growing 21% on top of 28% growth, that tells you this isn't just a blip. It suggests really strong fundamental demand. The market needs the capacity.
And is that demand coming from everywhere or specific areas?
It seems pretty broad-based. Good traction in both distribution, retailers, smaller projects, and the big institutional channels. Geographically, the North was strongest, followed by West, South, East. Kind of tracks with where infra spending is hottest.
Okay, and profitability in wires and cables. Margins improved too.
They did. Segment EBIT margins were up 270 basis points year on year, stood at 15.1% in Q2.
And just to clarify, why EBIT income before interest and tax? For the segment specifically, not EBITDA.
Good question. EBIT is useful here because it includes depreciation. So looking at EBIT margin improvement tells you how efficient the core manufacturing operation is after accounting for using up their assets, but before financing costs muddy the water. It's a cleaner operational metric for the segment itself.
Got it. But that efficiency must be hard to maintain with copper and aluminum prices swinging around. How do they manage that commodity risk?
Right, that's where their hedging comes in. They use derivatives, forwards, things like that to lock in prices for copper and aluminum and also manage foreign exchange risk.
Okay.
But the key thing, and they're very explicit about this, is their objective. They are not trying to make extra profit by speculating on commodity prices.
So they're basically saying, look, we make cables, We don't trade copper futures for a living.
Exactly that. They aim for a 1-to-1 hedge ratio. If they plan to buy X amount of copper, they hedge that exact amount. The goal is just to smooth out the volatility and maintain a relatively stable margin profile, regardless of what the LME does next week. It's about risk reduction, not profit enhancement through trading.
Okay, so wires and cables are the solid core. Let's look at the diversification efforts. FMH, fast-moving electrical goods. That business is profitable now, right? 3 quarters running.
Yes, that's a significant milestone for them.
Uh,
Validates the strategy somewhat. Within FMEG, the real star performer was solar products.
Riding that rooftop solar wave.
Absolutely. Those central and state incentives are giving it a massive boost. They're positioned well there.
But not everything was booming. Fans had a tough time.
Yeah, the long monsoon hit demand, plus there was apparently some extra inventory in the channel already, so fans were a weak spot.
And their strategy to fix that.
Pretty standard playbook, really. Push towards more premium products, focus on higher margin stuff like switches and switch gears, and try to run the factories more efficiently to get better operating leverage.
Which all feeds into that Project Spring goal for FM, aiming for what, an 8-10% EBITDA margin by FY30?
Exactly. It's clearly a margin improvement story they're building there.
Okay, now, EPC. Engineering, procurement, construction. First off, they've broken this out as its own segment now. Pulled it out of others.
They have, which signals, its growing importance, especially for snagging those big government infrastructure contracts.
Right. But its Q2 revenue was actually down 19%, same as Q1. How does that fit with growing importance?
Yeah, that's just the nature of big projects. Revenue recognition can be lumpy, depends purely on execution milestones hitting in a particular quarter. It's volatile.
Okay, but the margins look really high, 18.1%.
Yes. Need a footnote there. That 18.1% included a one-off gain, about 330 million rupees from a contract change.
Okay, so strip that out.
Right.
What's the real underlying margin?
If you take out the one-off, the core margin was right around 10%, which is actually bang in line with the range they've guided for in EPC. So operationally, it's stable even if revenue bounces around.
And is that lumpiness expected to smooth out? What's the outlook?
Looks much better for the second half. The order book is healthy. They've got that big RDSS contract, about 33.5 billion rupees, and the massive BharatNet project that's 80 billion rupees before GST.
Wow.
And they expect work on BharatNet to really kick off in Q3. So yeah, EPC should have a much stronger H2.
All right, let's zoom out to the big picture strategy Project Spring.
Yeah.
They mentioned being ahead of guidance on growth in these first 2 quarters. What else is happening under that banner? What are they actually doing?
Well, the most tangible thing is CapEx. They spent 7.5 billion rupees in the first half.
That's a fair chunk of change.
It is. And it puts them right on track for their full year guidance, which is 12 to 16 billion rupees. They're investing heavily in capacity and R&D for future growth.
Okay, so investing internally. What about looking outwards, international business?
Definitely a focus. Exports were up 25% year on year in H1. The goal is to get exports over 10% of total revenue by FY30.
How are they planning to hit that?
Partly by tapping into that whole China plus one trend, supply chain diversification. And they're actively working on getting approvals needed to sell into big markets like the US and Australia.
Makes sense. And alongside geography, they're also pushing into more specialized products, right?
Yes, very much so. A big focus on what they call special purpose cables, SPC. Think high-tech cables for specific uses, defense, railways, and especially automotive, EVs included.
High-value niches.
Exactly. That, plus the progress on their EHV extra high voltage plant, shows where the future focus lies.
Right, EHV was latest there. Is that on track?
They say it is. Installation should be done by the end of next calendar year. But given the long lead times for EHV projects, you probably won't see significant sales impact until fiscal 28. It's a long game.
Okay, so if you connect all these dots, the heavy CapEx, the EHV investment, the push into specialized SPC cables, it feels like they're positioning themselves perfectly for this huge Indian infra boom everyone's talking about.
Absolutely. The company presentation lays out the macro drivers pretty clearly. You've got massive projected investment in power transmission and distribution, over 9 trillion rupees in 7 years.
Trillion, wow.
Then there's the real estate cycle, expected to hit $1 trillion by 2030. And those sunrise sectors.
Like data centers?
Yep, capacity expected to double by FY27. And electric vehicles, the government's targeting 30% electrification for private cars by 2030. Polycab seems to be building the specialized capacity needed to supply all these growing areas. #tag outro.
Okay, so let's try and synthesize this. What's the key takeaway from this deep dive? It feels like Polycab is firing on multiple cylinders. Record results, cleaning up that big tax issue, and executing this Project Spring strategy.
I think that's fair. They're showing strong operational discipline, they've removed a major uncertainty with the tax resolution, and they're clearly aligning themselves through investment and strategy with India's infrastructure growth story, plus managing commodity risk pretty carefully along the way.
The current results are impressive, driven largely by the traditional business.
Right, the bulk of the revenue today is still standard wires and cables. But looking forward, the investment, the strategic focus, it seems increasingly pointed toward these newer, more specialized areas.
Which brings us nicely to our final thought for you, the listener, to chew on.
Yeah, think about this. That push into special purpose cables for defense, EVs, railways, it's a tiny part of the business right now, low single digits. But management says it's expected to be their fastest growing vertical.
Okay.
So the question is, as infrastructure globally, and especially in India, demands more high-tech specialized components like EHV, like these SPCs, how quickly can these new segments really change the shape of Polycab's business? Can they grow fast enough to significantly challenge the dominance of the traditional wires and cables market within, say, the next 5 years?
That's the trajectory to watch, a potential shift from volume to high-value specialization.
Yeah.
Interesting times ahead for them.
Indeed.
All right, hope that gives you plenty to think about. Thanks for joining us for this deep dive.
Thank you.
We'll catch you on the next one.